Hello everyone, my name is Mark and I'll be doing your training today. The agenda, which you should see in front of you, we're going to go over dependent of another, when kids can be claimed by the parents, some forms of income, adjustments to income, mainly itemized deduction. That'll be the brunt of the training. Schedule A, also injured spouse, and direct debit when the client actually owes money to the IRS, Michigan, or Lansing, or one of the cities, and then we'll do a problem to put it all together. Before we begin, hopefully you guys can log into your Atom the same way you've been doing in class. And I'm going to be following the manual quite a bit today. So if you don't have it in front of you and you want to pull it up online, I believe I sent it to you in a message, but if not, you can always go into any one of the problems. If I click on Friday class problems, I'm just going to go into number 22 because that's what we're doing today. And under favorite links, this is where you'll find common manuals, guides, whatever that you'll use quite a bit. So in this case, we have the property tax search. Here's the basic manual. You can click on that and open it up if it's easier, or just use the binder that we gave you. All right. And I'm going to pull the agenda back up one more time. So first, we're going to talk about dependent of another. And I will show the client information sheet. So right here, the very first question, can someone claim you as a dependent? So a lot of you guys are students and you're probably being claimed by your parents because they're the ones paying for your support. You may have a job, but it's not making that much money, so you're really not supporting yourself. You're not paying. The main thing is, are you paying more than half of your support? So usually no, because your parents might be paying for your school, your room and board, all that. So we do a lot of student returns, so they would check the box, yes, I'm being claimed as a dependent. So then what you need to do, or we might be do the parents returns, and then we also do the kids return. That's probably more common than a student actually coming in and getting their tax returns filed, because a lot of times they may not even be required to file because they made such a small amount of money. But if we do the parents returns, a lot of times the parents will just throw the W-2s at us, which are their kids, and maybe they made $4,000 or $5,000, and they do get a refund back. But the only way to get that refund is to file a return. So we just charge $25 if it's a dependent of another. So if we're doing the parents returns and then we do the kids returns, then we just charge $25 for the kids return because it's really very simple and basic. And we're already charging the parents something, so we don't want to charge a whole lot for the student's return. Okay, so in Drake, I'm going to go over here and I'm going to go into Betty's problem here. And all you would do is on screen 1, right here, there's a box which we haven't discussed at all. It just check the box dependent of another. And then when I view the return, what it actually does to the tax return, it all depends on the income of the taxpayer. If you look at the 1040, the only thing that gets changed on the 1040, nothing actually gets changed. So the standard deduction is exactly the same as if they weren't being claimed. But when you go to Michigan, your standard deduction here, or they call it an exemption, now it's 0 because your exemption, this $4,400 deduction, is actually now going on the parent's return because the parents will claim you as a dependent. Okay, so you can't get that exemption on your return because the parents are actually getting it on their return. So what you do get is a small $1,500 deduction when you're being claimed as a dependent. So then you take your total income, then you subtract $1,500 from it, and then to arrive at whatever your tax is. Lansing, there's no adjustment. You get your little $600 exemption deduction here. The reason on the federal, so in 2018, they changed the tax law, so there actually are no exemptions anymore on the federal return. They just bumped the standard deduction. They basically doubled it. So because there are no exemptions, there actually is no change on the federal return. So it actually is in the favor of the person being claimed as a dependent, because usually the income is not above $12,000 if you're being claimed as a dependent on someone else's tax return, because that usually means you didn't make that much money. So in that case, you would get all your federal taxes that they take out of your paycheck back. So it's very simple. All you gotta do is check a box. It's also very simple to not check the box. So if you do not check the box and we file the student's return before the parent's return, it will get accepted by the IRS. And then when the parent goes to file the tax return and claiming, this student as a dependent on their return, it'll get rejected saying that that student just filed a tax return already, so you cannot claim them as a dependent anymore. Unfortunately, this happens every single year in our tax office. So all I say is pay attention. If it's marked or if you're actually doing the student returns while you're doing the parents' returns, please remember to check that box, because this makes our parents of our client here very angry when now what they're going to have to do is mail that tax return in, because we can no longer electronically file it. It's going to delay the refund. It's just a huge mess. Then we have to amend the student's return that we just did and say that no, they're supposed to be filed as a dependent of another. So it's very simple to do. Just check a box. Again, if you don't check the box and you're supposed to, it becomes a huge mess. All right. So all I say is just pay attention. That's all I can say. And just make sure you check the box. All right. Enough of that. Let's move on to the next subject we're going to talk about, and that is income. So for the most part, we talked about W-2 income, which is typically on every single tax return, almost. We talked about unemployment. We talked about Social Security. We talked about retirement income. Now another form of income that we do see is interest income. So if the money is in, there's not a ton of interest being earned right now on bank accounts and all that, but we do have clients. Usually we don't get these clients until like into February. Say they're retired, they have quite a bit of money in the bank. So they do have, or a CD, so it is earning interest, and they have to pay taxes on any earnings that they make. So if it's interest income, they have to pay taxes on it. So we add it in as income. So what they will get, let me minimize this, and I'm going to pull up my manual now. Basic manual, and on let's go to page 105. So they're going to get a 1099 INT for interest. So they all have different forms and shapes, just like a W-2. So this is just one of them. So it'll show you the amount of interest income. In this example, $182.59. If they have any federal withholding, typically they do not. And that's basically, for the most part, 90% of them, that's all you're going to that's all you see. Okay, there's other things on here, but typically it's just all of this is reporting interest income. And where that gets reported in Drake, you go to page 18. This is the general tab right here. You'll see a 1099 INT. You either can click on that or you can type INT. Again, anything over here, these are little shortcuts, and you can enter that in the field here, and it'll pop you into the screen, whatever is easier for you. And that's going to shove you right into this screen here, the INT screen. And from here, all you're going to do is enter. Now, in this example here in the manual, we entered more than I think is necessary. We entered the EIN number, and this is all coming from the 1099 INT, just like a W-2. Enter the federal ID number, the name of the bank, if it is a bank, the address, and then the dollar amount right here. So interest income 422. In this example here, and there's actually we're showing also an early withdrawal penalty. You typically don't see that. Usually just right here in box 1. In fact, you can just enter, I don't even care if you enter the federal ID number, just enter the bank name. We're not required to enter this or the address. So as you should know now, I like to do things with shortcuts. I like to do it correctly, but we don't have to overdo it. Okay, just put in what you're required to put in. You don't have to put in more than what you're required to put in. Tax return is correct. So I think this is overkill, putting the federal ID number in and the address. The bank name is just fine. Okay. So I'm gonna do, when I do the problem, because I was gonna pop back and forth into Betty, but I'm thinking like I'm just kind of duplicating because I'm doing the actual problem with all this already, then there's no reason to do two problems. So I'm just going to demonstrate this all when I do problem 22. All right, so now I'm going to skip over this one right here, state and local refunds, until we talk about Schedule A, because they kind of go together and it'll make more sense. All right, so next we're going to talk about educator expense. And this is adjustment to income. So I have my income, and I'm able to make adjustments like deductions. Okay, and then that arrives at my adjusted gross income. So what an educator expense is, let me make this bigger. So these are for teachers. So they made a special allowance for teachers because if any of you parents are a teacher, you would probably know this, that they tend to spend a lot of money on their classrooms for their students, and they don't get reimbursed at all. So it's just money out of their pocket. They might bring decorations in for Christmas, Halloween, whatever, or supplies, and the school just has no money to even reimburse them for that. So this is just coming out of their pocket. So what the government did is allow them at least to make a tax deduction on their tax return up to a certain dollar amount. So it's not a lot, okay, but we don't want to miss it. So the only way to know it, either if the client tells us, or on the client information sheet it says occupation. So if it says teacher, then your next question would be, did you spend any money on supplies? And then I'd say probably 90% of the time they did. Okay. And then the limit is $250 per person. So if it's a married couple and it's actually taxpayer and spouse, it would be actually $250 each. So total would be $500 that they could actually claim on their tax return as a deduction. So you just have to ask, did you spend any money on supplies? And we do teachers returns, not a ton of them, but just so you know, you'd want to ask that question. Or you can always look at last year's return too, which I strongly encourage you to go into Drake and look at the prior year return. And again, it's like a cheat sheet because 90% of the time, what they did in last year's return is probably what they do in this year's return. Just take the numbers and change them up a little bit. So it's almost all you're doing is duplicating. So it makes it very easy to do. And because we're not going to have clients in front of us this year, it makes it even easier to do. So, with COVID, it's a huge challenge, but there's some positives to this too. So let's take advantage of the positives. So let's cheat and look at last year's return. So you're not blind, okay? So especially with you guys being new, everything's new to you. So let's look at last year's return. Takes like 2 minutes, if that. And now you're pretty confident when you do this year's return, you're probably doing it correctly because it's almost a mimic of last year's, just change the numbers a little bit. All right. Anyway, sorry, I got off track there. But so this is going to go where we report this. Pull my manual back up. And it is on page 31. So, and it's adjustment, numbered screen 4. And again, you can either enter 4 or you can click on adjustment. It's going to pop you right into the adjustment screen. And it's a very simple entry right there, line 23, educator expenses. In this example, we entered 497. You see it's taxpayer. So I know I said 500, but that's 250 a person. Okay, so 500 is only if they're a married couple, so it'd be 250, 250. So in this example, 497, Drake is smart enough to actually know the tax law, and it caps it at 250. So you can enter the full amount in there. If they say I spent 1,000, enter 1,000 in. Okay, it might make them feel good. Now, granted, they're not going to be sitting in front of us, but typically when they're in front of us, they like to see you enter the full amount in so they don't feel like you're shortchanging them. And then the software will automatically cap it because that is the tax law. So when I view this return, it would only show up as 250 on the actual tax return. And it doesn't look like in the manual. I'll demonstrate all this stuff when I do the problem where it actually flows. It's at the front of the 1040. as an adjustment, and it just subtracts it from the income. So it's not huge. It might help them get an extra, all depends on what tax bracket they're in, maybe another $15, $20. But again, our job is to do an accurate return, get them the biggest refund, and this is how we do it. So just want to point this out. So educator expense. Okay. Now they have to actually spend the money. So just because they're a teacher, they don't automatically get $250. Okay, they actually have to pay for supplies. But again, based on my experience, I'd say about 90% of the teachers do buy supplies for their classroom, and they probably do exceed $250. Okay, next. Itemized deductions. Okay, this is the main focus of this training, is itemized deductions. Schedule A. Your parents are probably aware of this. Okay, so usually if you're homeowners, then they pay a mortgage. And so say you buy a house for $200,000. Obviously, you're paying a bank. Usually you're paying a bank to pay that off, and it could spread over 30 years. So you pay a little bit each month. Part of it goes to the principal, which would be that $200,000 that you're paying on the house. And then the other part of it is what the bank is charging you for interest. Okay, so the interest portion is tax deductible on your tax return. All right, so it used to be, as soon as you're a homeowner, everyone thought, oh, I get big refunds because now I can claim all these tax deductions like my mortgage interest, my property taxes on my house, my charitable donations. Okay, and all that is true. Okay, and it used to actually benefit them, and they used to get bigger refunds. But now, as of 2018, when the tax law changed, the standard deduction, which you guys should be familiar with because that's all we've been doing so far, is standard deduction tax returns. So filing status single, their standard deduction is $12,200. I believe that's what it is, or $12,400. If they're head of household, it's $18,350 standard deduction. Married couple, it's like a little over $24,000. So that's been the standard deduction, and that's what you guys have been doing for all the problems up until today. Okay. There's also standard deduction, and it compares it to what's called an itemized deduction. And the only difference is itemized means we're just going to list out all these deductions that you might be allowed and compare that to the standard deduction, and then we take the higher of the two. So believe it or not, all these problems we've been doing, the last 21 problems, Drake Software has been doing this behind the scenes, but because we've never keyed hardly anything in related to an itemized deduction, the standard deduction has always been higher. So the software automatically does it for us. It's just all these problems we've done so far, they really have not had any itemized deductions. So this problem today is going to have some of these deductions that are allowed because this person is a homeowner and he's paying like a high mortgage. Okay, hopefully I didn't confuse you, but that's pretty much related to a Schedule A. So many of our clients now, especially married couples, the standard deduction, because it is so high, they're not able to itemize because they're better off taking the standard deduction. All right. Typically, the only ones right now that are it's beneficial to claim all these itemized deductions, which we're going to go over in a second, is like a single person, because the standard deduction is so low, like $12,200. So it's easier to get above that amount when you're a homeowner than a married couple trying to get above $24,000. All right. So with all that being said, let's go ahead and see what's all on this Schedule A and what are these itemized deductions all about. All right, so we're going to go to page 36. Chapter 4. I have a whole chapter just on Schedule A. So this used to be a really big thing. It's not as big a thing as it used to be just because of that standard deduction being so high. But that's important for you to know that, because the clients know that now. We've educated them over the last 2 years related to taking the standard deduction over the itemized deductions, because a lot of our married couples, it used to be the other way around. They always itemized. So that first year in 2018, that was a huge educational piece we had to tell them, is that no, now the standard deduction's better. You're getting a bigger refund because you're claiming standard. Okay. Now they've gone 2 years in. Now they're into year 3 of that. So they're fairly educated, So they might even talk to you and say like, yeah, I'm a homeowner and I have donations, but it doesn't help me anymore. So now you know what they're talking about. So you don't have to look like blank in the face staring at them like, I don't even know what you're talking about, lady. So it's because the standard deduction is so high, their itemized deductions don't help them anymore. And we want to give them the biggest refund. So we want to take the standard deduction if it's going to be larger than their itemized deductions. So it is important for you to know that so you know what they're talking about. You don't want them to be more educated than you related to taxes. Okay. So Schedule A here, how we get to Schedule A, and that's just the form it's on. Schedule A lists all the itemized deductions. So again, it's right here, itemized deduction schedule. Schedule A, click type A, or you click on it. Then we pop into here. This is exactly what I've been taught. Claim the standard deduction or itemized, what we just talked about. To access the screen, to double click. Yeah, we talked about that. This is it's Drake's going to automatically take the higher of the two, standard or itemized, and it's about all I want to talk about that. All right, now I'm in the screen. This is what the screen looks like. So if you're in your Drake and you click on A, it should look exactly like this. So the ones I want to talk about are pretty much the fields that we have dollar amounts in. So right at the top, again, you have medical, dental, you have taxes you paid, interest you paid, gifts to charity, and other miscellaneous. We don't have to worry about that anymore. These are all, and the reason I say itemized is because you're listing them out. Charity, real estate taxes, mortgage interest, you're itemizing them. That's why it's called itemized deductions. Okay, standard is just government said you're going to get 12,200. I don't care. I don't care anything about you. You're getting that because you're single. That's your filing status. Okay. So I'm going to add these all up, see if it's better than my standard deduction. If it is, Drake automatically takes it. If it's not, Drake will automatically take the standard deduction, takes the higher of the two. Very first, medical and dental. I can deduct my health insurance premiums. Right here we have 3,157. I can deduct medical miles. So if I'm driving back and forth to the doctor, I got to go out of state. I even got to stay in a hotel. Usually these are our senior citizens, they're older, they have more medical problems, so they have higher medical bills. Prescription drugs, that's a medical expense. Co-pays, those are medical expenses. Now, if they have no insurance, which hopefully they have insurance, obviously they might have pretty huge medical bills, or because people have such high deductibles now, their medical bills may be higher. Anyways, all you do is list them all out. So medical miles, these are actually the miles, 122. So Drake, you actually will get 20 cents per mile for medical miles. So when you're doing clients that are older, one is they typically don't have a job. They have more free time on their hands. They track all this stuff. They track all their medical miles. They track all their copays. They track all the prescription drugs, okay? They will come in with a stack of papers. Enter the totals in. We want the totals, okay? So they're the ones that do that. People that are 50 and younger or 60 and younger working, they're busy. One is, this really isn't going to help a lot of people anyways. And two, they don't have the time to track their miles as they go back and forth from the doctor here and there. One, they don't have as many trips because they're healthier, because they're younger, typically. But anyway, that's how this works. Now, the one thing I want you to remember is obviously medical and dental are deductible. In this area right here, they have to get above, these numbers here have to get above 7.5% of their adjusted gross income. So the adjusted gross income is their total income less a little adjustments, like we just had an educator expense deduction. It was an adjustment to their income. So I'd multiply 7.5%. So if it's 100,000 they made, 7.5% times 100,000 is 7,500. All these added together have to get above 7,500 before I can even take $1 as a deduction. Okay, that's what you need to remember. 7.5% is the key you have to remember. So when a client says, "Yeah, I had some medical expenses, I didn't have enough to get above anything to help me." So if I didn't explain this to you, you'd be looking at them like, I don't even know what you're talking about. So what they're talking about is they have to get above 7.5% of their gross income, adjusted gross income, before any of it is deductible. Typically, if they're still working, that means their income's higher. One, they're not as sick. They don't have as many medical bills. Their income is higher. It's harder to get above 7.5%. When you're retired and you're older, your medical bills are higher because you're older. Your income's lower because you're not working. It's easier to get above 7.5% of your adjusted gross income. So our senior citizens, they probably can get above it, okay? Our person working today probably cannot, all right? That's what you need to remember. Most of these returns you're going to do, the medical is not going to help them. I can tell you that right now. Most of the returns you do right now, you're going to take the standard deduction because their itemized deductions are not going to be above the standard deduction. That's what you need to remember. Next, taxes you paid. Line 5, income taxes. What this is income taxes you've paid, the taxpayer and the spouse, to the state government, to the city government. Okay, so this would be not federal government. So when you're working and they're taking money out of your paycheck and you come in with a W-2 and it shows state withholding, city withholding, that amount of withholding is the tax deduction that goes on this line right here. It automatically flows in from the W-2. So you key it in Drake in the W-2 screen, it automatically flows right here. Now you won't see it right here in the data entry mode. You're going to see it when you view the return and it'll flow in, and that's where that number is popping from. State and city income taxes paid. That's that. The plus and minus, the reason there's a plus and minus is because say they filed a tax return last year and they owed the state of Michigan $1,000. So it showed balance due $1,000. So they wrote a check and paid it. That amount would go right here because that would be in addition to what they're taking out of their W-2. Most likely you're probably not going to do any returns like that. General sales tax. So it's the higher of the two. So it takes either the income tax paid, state and city, or what they paid in sales tax over the year. So in Michigan, we have a 6% sales tax. So you can either add all that up every time you go to the store and you pay sales tax and come in here with all your receipts and say, this is what I paid in sales tax. I've only had one person do that in all the years I've been doing taxes because that means you really have way too much time on your hands. Okay. So because that's a pain in the butt to add all that up, so the government's already defaulted that based on your income, your adjusted gross income, we're going to there's a formula that goes through and calculates what they believe you probably paid in sales tax over the year. And that's usually what everybody does. Okay. The software automatically does that for you. There's nothing you have to do. So the software is going to automatically compare the two and take the higher of the two. Normally, if they're working, it's always going to be what they paid in state and city taxes because they're working and it'll be higher than their sales tax. If they're not working and they didn't pay any state taxes, well then obviously it's going to be the sales tax. So Drake will automatically take the higher of the two. Now, over here where it says S tax, there's this, so it's sales tax, that's the sales tax form, which, where is that? Right here, sales tax worksheet. So right underneath Schedule A where it says S tax here, this is only if they bought a big ticket item like a boat, a truck, a car, something that you don't normally buy like if you go buy clothes or whatever, obviously you're doing that all the time. So the general sales tax automatically gets calculated based on your income. But, you know, every 5 years you buy a new car and it's usually a large ticket item, $30,000, $40,000. So you can actually write the dollar amount of sales tax you paid for that large ticket item here on the S tax screen, right here, line 7. It automatically gets factored in and added to whatever your overall sales tax are, and it would automatically flow into the Schedule A. Hopefully I'm not losing you guys here. Okay, so that's so again, the higher of the two, software automatically does it, either your state and city taxes paid or your sales tax. Now you can force it. You see a checkbox here, force sales tax, force income tax, but typically I don't think I've ever checked those boxes. It'll just take the higher of the two. But what you want to remember is, again, a client might come in and say, "Oh, I bought a new car this year." So you know what that means. The reason they're telling you they bought a new car this year is because they know sales tax on the car may help them. Okay, so you just would say, "Oh, that's good. We'll add in what you paid in sales tax and see if that helps you." Okay. So I'm trying to teach you. I don't want the client to know more than you guys know. Okay. So um, if they say something and you don't know it, then just say, "Okay, I'll just double check with the senior preparer or something on that." But hopefully some of the stuff you remember. I know I'm giving you a lot of stuff, but some of this you remember, and as you do it over and over again, it'll keep sinking in. Okay, real estate taxes. Those are real estate property taxes on your house. So far we've done like the property tax credit for Michigan. And so those are property taxes assessed. So then you can, that's a separate thing. That's kind of like for the homestead property tax credit. These are the taxes actually paid in the current year. Okay, so you have to know what actually was paid, not just assessed, but paid. If we're doing a 2020 return, what was paid in 2020? And I'm going to show you where you look that up. Same spot we did before when I do the problem. That's what this is right here. Don't worry about the line underneath here. Personal property, line 5C. This is personal property taxes in the state of Michigan. These are going to be your car registration tags. So if you guys own a car and you go and renew the plates every year and you get the little sticker you put on the back of your license plate and you have to pay, say, $150 or whatever it is, that's personal property taxes. So it's not a lot, but typically if someone owns a house, they own a car too. So they are going to have car registration tags. Okay. I sometimes guesstimate it. Okay. As opposed to the client having to run up to their car and dig through their box and find what they paid. It's usually not a hard, one is it doesn't amount to a huge amount of tax deductions. So, but they know they get to deduct it. So, even though it's small, we want to make sure we don't miss anything. That's it. So personal property taxes are car registration tags. All right. Home mortgage interest. So if they own a home, most likely it's not paid off yet. They're paying the bank. So the portion of mortgage interest is tax deductible. What they pay on the actual loan, the principal, is not. So they'll come in with a statement. It's a Form 1098 form, and I have one here. Each bank has a different look to it. So in this case, it's 2021. It's going to show mortgage interest received. That's what you put as a tax deduction on the Schedule A. Other than that, you might see something down here in box 5, mortgage insurance premiums. And what that is, so when they took out the mortgage, if they didn't put enough money down, then the bank actually takes out like insurance on that mortgage to make sure in case this person's delinquent and doesn't pay the bank the money. So it's mortgage insurance premiums that the borrower, the homeowner, has to pay. So those are tax deductible too. It'll show it in box 5. So you're just going to look in box 1 and box 5. And all you do is come in here and it's right down here, line 8C, mortgage insurance premiums. Just put the dollar amount. So they'll come in with a 1098. They're really pretty good at that, doing that. And you just would put the amounts in here. All you're doing is, again, now it is data entry, but you do have to know where to put the stuff. And know what's allowed and what's not. I mean, normally if they're a homeowner, they probably have property taxes they pay during the year. Because they're required to. Sometimes they don't pay it, but usually they do. Mortgage interest, they usually have that. A lot of times they have mortgage insurance premiums. They usually have car registration tags. Usually medical bills, they rarely are able to claim that because they got to get above that 7.5%. So it's hard for people that are working. Next, over here, charity, gifts to charity. So donations to the church, whatever, Girl Scout, Boy Scouts, whatever, if they're giving money, so cash or check, obviously credit card too, that would be right here. All right, and if you look here, it's red because if you double click this, you can then itemize them out. So say someone comes in with, I gave, to Michigan State, I gave to St. Gerard Church, I gave to, another church, whatever. You can actually list them out if you want, if it's easier, or you can just throw the total dollar amount in there. Line 12 here, and also you can also do charitable miles. Typically I don't get a lot of people that do miles, but if they give you miles, just put the dollar amount in here, and I think it's maybe 19 or 20 cents a mile. I got my quick finder here. It is 14 cents a mile for charity. You just put the miles here, and the software will do the rest. Other than cash or check, that's going to be like Goodwill, Salvation Army. You're giving their clients giving clothing. They'll come in with these pink slips, shows how many bags they did. They have to come up with a value of what the bag is worth. So it's basically what they could sell it for at a garage sale type thing. And there is a list that they can get online and come up with the value, but they're supposed to give you the value of, the clothing or whatever they gave, electrical, computers, whatever they did, and you put it here. Now, if it's higher than $500, you have to fill out another form 8283, that kind of itemizes the items you gave to charity. We're not going to get into that for this class, but that would be right here. Typically, the returns you're going to do are probably going to be small amounts right here. Now, one thing I want to point out that's new for the 2020 tax season is that gifts to charity right now, I think for the 24 years, whatever I've been doing taxes, I don't know if they've ever did this before. So usually the only time we could do gifts to charity and claim it as a deduction is if we filled out Schedule A, and obviously Schedule A total was larger than our standard deduction. So we have a lot of people that can't itemize anymore, right? Because I just explained to you, standard deduction doubled 2 years ago. It's harder for people to itemize. So they claim the standard deduction. So they were a little upset, thinking, God, now I give to charity, give to my church, and I can't even claim it as a deduction anymore. Well, because of COVID, they made a tax law change, and I don't know if it's going to extend on beyond the 2020 filing season, but for 2020, you can actually deduct up to $300, and that's per tax return, not individual, without having to itemize. So I can't demonstrate that to you because I don't have the 2020 software yet, but it'll be a line item out. And I think with what Drake said is we actually still go into Schedule A and we'll enter it here. And then it's going to take 300 and put it on the front of I think it's going to be on the front of the 1040 as a deduction of your overall income. So even if you don't itemize on the Schedule A, you'll still get at least up to a $300 deduction as long as you contributed at least $300. So a lot of people will give at least $300 to, or say they did, to the church or wherever. So I think most of our clients, not the early filers, but the later filers that are making at least 50,000 or so, 40,000, they probably do give money, and they probably never have claimed it before because one, they might not be a homeowner, or two, they know they're not going to itemize because they just don't have enough deductions. Now they're going to be able to. So we're actually going to, I can't show it to you right now, but we're just put a change in on our client info sheet. And Miss Porter is one. I think we're going to have another question here, line 6. It's going to say, did you make any contributions last year? Like a yes or no. Now, I mean, right down here, we do have where it says contributions, charitable donations, but I think they're going to be so used to just blowing this off because they've never been able to claim them before that they're just going to overlook that, and we're going to miss a lot of deductions that they might be eligible for. So it's similar to like the educator expense, $250, not a big deal. This one's $300. So, hey, it's going to help. And the thing is, if you don't ask the question, I can guarantee you their neighbor, their friend, their relative, someone's going to say to them, hey, did your preparer did they ask you about charitable? Because this year you can do 300 regardless. And they're going to think 300. Oh, there's an extra 300 in my pocket. Well, no, it's not 300 in a pocket. It's a deduction. But so we want to make sure we cover our bases and ask the questions because people talk. Okay, they talk to their neighbors and all that, and they always compare returns to each other, even though they really shouldn't be doing that because usually a return is not this. No one's return is the same. But they do it all the time. Okay, so I don't want those when the client calls us and says, hey, David did my return. He didn't ask me anything about charity. Okay, but my neighbor said there's a new special deduction this year about charity. and I didn't even get asked about it. We don't want that to happen. So that's why we're going to list a question right here. And if they had more than 3, and we might have to ask how much did you have, or maybe I'll even have it right in somehow in here, because a lot of people are going to be dropping this off. But I don't want to miss that, and I think a lot of our clients will be eligible for that deduction this year. Anyway, that's charity. And that's about it for Schedule A. So I know I spent a little bit of time. It is kind of important. It's not as important as it used to be because most people still do standard deduction. But this section, charity right here, is going to come into play for 2020 this year. And I think a lot of people are going to get at least $300 deduction. You just will put it in here. It'll automatically flow to the front of it if they're not going to be doing a Schedule A. Okay, next topic. Usually I give you a break, but I know you can just stop this and break anytime you want. Hopefully you're paying attention. Injured spouse form. This isn't going to be part of the problem because you won't be doing a lot of these, but you need to be aware of how this works. And we did do a good job this year. Pretty excited about it on our client information sheet. So now we actually ask the question, injured spouse, if so, which spouse owes the debt? Okay, so what an injured spouse form is, and I think I have something on the manual. Let's see here. Page 33 of my manual. Doing so good, keeping to the manual today. Okay, so it's form 8379 is our injured spouse claim. All right, let's see what we talk about on that. Gives you a little information. So what an injured spouse, what that means is you're going to have a married couple. So you're going to be doing a joint tax return. One of those spouses, either the husband or the wife, somebody has a debt out there. And so say they're getting a $10,000 refund, and say the husband, because usually it's the guy, owes money for whatever, child support, back taxes, student loans they didn't pay on. Someone's going to grab that refund to pay that debt. Okay, so say if the husband owes $20,000 in child support to another, to the mother of his kids from many, many years ago, whatever, because we do a lot of those tax returns. All right, so that refund, and if he has a $20,000 debt, that whole $10,000, because he's doing a joint return. So joint return means if you have debt, they're grabbing that whole refund, regardless of whose refund it should be. They'll take that whole 10 grand and apply it toward that child support. Okay, so his new wife is going to say, I am not losing my refund to pay for your problems you had in the past because you got these kids, you're with that deadbeat woman, whatever. And now I'm not going to let that $10,000, my refund, go to pay for your child support. Okay, we just got married this year. That's your life in the past. I have nothing to do with it. You're not getting my refund. Okay, so that woman, the wife, would have two options. One, they could do a married filing separate, which we haven't really talked about. That's basically you got a married couple and they both file separately. So her refund would be hers. If he has debt, government can't get it. Okay, and his refund, if he has one, would be his. And so if he has that $20,000 debt, government would take that money and apply it toward that debt. So sometimes people do that. The problem with married filing separate is typically it's the worst way to file. It's the worst filing status because a lot of credits are not allowed. So usually the refund is less. So say if they're normally going to get a $10,000 refund as married filing joint, and they did two married filing separate, say that refund gets cut to like only a total of $6,000. So then in this example, the wife's like, well, heck no, I'm not going to get my refund cut in half to $4,000 because of you. All right. And then she might say to you, the tax preparer, do I have any options? Or so what but the thing is now this injured spouse form has been out so many years that they tend to know it. I don't know how they got so educated, the client, but they did. And so I'm so glad that we stole this from Jackson Hewitt's client intake form. But now we have it listed here so they can actually tell us, because a lot of times over the phone they'll say, I got to file an injured spouse form, make sure I get a senior preparer that knows what they're doing. So And we do want to make sure we do, because it is a little tricky and you don't want to screw it up because they're already pissed because some of the refund might be getting taken. And so we don't want to make a mistake because that'll just make them more pissed. All right, so they would actually put who's got the debt. So in this, and I'm telling you, probably 90% of the time it's the guy. All right, I don't know why, but it is. Not always, but it is. So they would put the person's name. So now we know whoever has the debt is not considered the injured party for the injured spouse. The injured person is the one whose refund would be taken to pay this other person's debt. All right, don't get confused because they're both going to say they're injured. The guy's going to say, yeah, I'm injured. They're going to take my refund to pay my debt. Well, it's your debt. Take care of it. It's your responsibility. All right. But now the wife, who has no debt, so she shouldn't have to have her refund go to pay his debt. All right. So she's considered the injured party for tax purposes on this tax return. So she's injured in this example. So the form is 8379. This is what the screen looks like. And I do not want you to do this on your own. I don't want you to probably do one of these on your own the entire tax year. Okay. You may do 2 or 3 of them. Okay. And that's probably about it. If you do more than that, that would be, unfortunately, just grab the ones that have injured spouse. But I want a senior preparer to double check this every single time on really anyone who does these injured spouse forms. Okay. Because it's not that it's that tricky. I mean, you have to know what you're doing, just like anything else in the software. But if you screw it up, you're going to piss them off so bad, and we will not hear the end of it for many, many months. Okay. And the reason that is because this actually has to be updated. This is now, IRS is going to take 16, if you do an injured spouse form, it takes 16 weeks before they will get their refund. A typical refund comes in 2 weeks. Now it's 16 weeks. That's 4 months. Okay, they're going to wait a long time. They're okay with that. Okay, you got to tell them up front. They're pretty educated now. They kind of know. The 16 weeks, I think, just happened last year, so they might not know it's 16 weeks. But we want to. That's one thing we want to tell them. You know it's going to take 16 weeks. Okay, before you get your refund. And they're like, fine, at least I'm getting something. Okay, I don't want my whole 10 grand to go pay this person, my deadbeat husband's debt. Okay, they're fine with it. But if you screw it up, the injured spouse form, they might not get notification that it's screwed up until like 16 weeks from now. Okay, so when they're waiting, they find out, oh no, because it was done wrong. So you can correct it. That's a good thing about taxes. You can usually correct everything. Problem is, now they're gonna have to wait another 16 weeks. You think they're gonna be mad? Oh yeah, they're gonna be mad. Okay, and they're gonna yell at us for 16 weeks. We don't want that to happen. Senior preparer, and hopefully the senior preparer doesn't screw it up. But because we'll have to refund them all their money, and again, they're gonna yell. We don't want to do anything wrong, but then we know this client would definitely be angry. So what I want you to take from this little lecture here is that you're aware of the injured spouse form, okay, and you kind of have an idea how it works. And I'm not even going to go into how to do the form. You can play around with it if you have free time, but because I want you to get help. So all I want you to know is that, oh, injured spouse, I need help. Now we have it on a client info sheet. I'm so happy because now you know right off the bat, and then you just get a senior preparer to help you. So that's why I want you to know about the injured spouse form. And it does work. And one more thing is you can do it after the fact. So say if a client comes in and this happens, a newly married couple, and again, I'm going to use the husband as the person who has the debt. They file a return. Husband doesn't tell the wife at all that he has debt, okay, because one, he doesn't want to deal with it. Okay, so they file the return. All of a sudden, they call us up. Hey, I've been waiting 2-3 weeks. I don't have my refund yet. What's going on with it? You guys screw up? So we look it up and we say like, oh, it looks like your whole refund got garnished to pay a debt. And then this has happened. It happens actually quite a bit. It's kind of humorous, I guess, because I know what the husband's going to go through. So, the married couple, she'll say, I don't have a debt. And then she talks to the husband. And then he says, I don't have a debt either. Still thinking he's going to get over on her. And then, of course, you dig in deeper and you contact the IRS, and they'll actually tell you and they'll get a letter eventually saying who has the debt. So it's not like the husband's going to get out of it. And then at that point, but we can still file this form after the fact, and she will get her money. It's just, again, it's going to be 16 weeks. So what I want you to know is that you actually can file this after the fact. So even if the money's been taken, file the form, and the IRS will actually divide it up and determine who's going to get which of the refund. So, all right, next, direct debit, taxes owed. So if the client actually owes money, so far we've just been doing direct deposit. And this is actually an advanced manual, but we're going to move it over to the basic manual probably in the next few days. So right here, you guys have been doing, if you see here, DD, it says direct deposit. That means they're getting a refund. The money goes directly in. PMT, electronic funds withdrawal, that means if they owe money, they can actually have the money come out of their bank account and actually pay what they owe. So that's becoming more popular as opposed to them having to handwrite a check. So we actually added it. It's a new addition to our client info sheet at the very bottom here. Again, I'm kind of excited about that too. So here, we're going to say, how would you like to pay for our services? They can tell us how they want to pay. How would you like to receive your refund? Obviously, direct deposit. That's what we've been talking about. If you owe the IRS, state, or city, how would you like to pay? Direct debit. A lot of people don't realize they can even do it. They might be like, wow, I can do this now. Well, actually, they could do it for many, many years, but I didn't do a good job explaining it to our preparers. So now you guys need to know how to do this because it's on the client information sheet. I think it's becoming more popular. Who wants to write a check to the city of Lansing for $2? I mean, when you can just have it automatically come out of your account. We want to make it as painless and easy for the client as possible. So I think a very easy, painless way is to just do direct debit and it comes right out of their account, as opposed to having to remember to write a check for $2 or whatever it is. So not everyone wants to do it. It's offered. You need to know how to do it. Okay, so it's right here, PMT screen. Click on that. You're just going to fill this out just like direct deposit, routing number, account number, which is coming out. Federal, yes. If it's state or city, you put MI for Michigan. If you need to do Lansing too, East Lansing doesn't offer it unless it's new this year. And I can't remember if Jackson does. Lansing does. Okay, so you then would put LN down here. So if I had federal, state, and city, I would have to do these up here would take care of federal and state, and then I do city, and I have to do it all over again down here. And then also, you check the box 1040, that ties into the federal. The requested payment date, you get to actually pick the date you want it to come out of your bank account. It's going to default to the due date, so April 15th, which is a due date for making a payment to the IRS. It'll default there unless you override it with a date. Same way with down here, so it's state payment amount is going to default to the amount that they owe, which usually is what they want to pay. And the payment date right here would be for the state. It'll default to the April 15th date unless you put in otherwise. Now, a lot of our clients don't like to wait till April 15th because they feel like, it's too close. Like say if they're mailing the check in, some do wait till April 15th, but a lot of them will just send it in at least 2 or 3 days earlier, just in case something happens. So I found that tends to be the case too for the when they want to make their direct debit. So you just ask them, when would you like to do have the amount come out, and then you put it in here. But if you forget and it defaults to that date, it's not that big of a deal because it is going to be paid on time. Okay, we'll have record of it, and the client will have documentation too. So that is it for. I think I went through the agenda. Okay, now we're going to do problem 22. So I'm going to do the same problem you guys are going to do. So this should be. That's why I'm not doing 3 problems anymore, because I'm like, I can just shove everything in one problem and demonstrate it all, and then you guys do the problem. And then if you're still having problems with it, just do the problem again. Okay, because for the most part, what I'm showing you is real life stuff. So it's like. And we do have other problems too that can reinforce Schedule A and all that. So, and I encourage anything that you're struggling with, just keep doing practice problems, okay? And if you say, I ran out, guess what? We have a lot more practice problems. Okay, just keep on doing them until you get, you know, the real deal and you start doing them. So that's the only way we know to make this stuff sink in the best as possible. Okay, so I'm going to close this out, close my manual out, and then again, here's Friday class problems. I'm going to go into number 22. And now I'm writing my notes right here. Makes it easier for me. So I'm going to read these notes as I go along. Here's interest income. Here's my Schedule A stuff. I don't actually have the forms like this, like the Form 1098. You will have forms when it's real life, but it just, to create a problem with all those forms, it just creates, it like makes it 2 or 3 times longer to do. So unfortunately, it's not true real life. Okay, but I think this should be help. Oh, I forgot this part right here. The refund. Shoot, I forgot about the refund. Okay, so that was part of on the agenda. Let's get back to that. Let me go back to my manual. Did I close my manual out? Oh, I did. Okay, I'm gonna have to go back into back to my file. Again, I can go to my favorite link here, pull up my manual, and right here. So we're going to talk about had they received a so for interest or for the income, my examples. So far I talked about interest income. Then I was also going to talk about like income. Say they filed a return last year. So page 107. Okay. There it is. So on Schedule A, as I told you that, let me get back to it real quick. Schedule A, page 36. All right, right here, line 5, income taxes, state and city taxes. This is usually what comes out of my W-2 or shows up on my W-2. Okay, so say I paid state taxes of $1,000. They took $1,000 out of my, let's say $10,000. Took $10,000 out of my my paycheck for state taxes last year. Okay, but when I filed my tax return, I got $9,000. I got a $1,000 refund because they took too much money out. So how it works is I would actually record $10,000 here as a deduction. Okay, because that's what I paid in state taxes. But then it was like, wait a minute, but I got a $1,000 refund, so that doesn't really make sense, right? I really only paid $9,000 because I'm getting $1,000 back. Okay, and that's an exactly true statement. Okay, but the way it's going to work is because it's so you don't know that until you actually file your tax return, you're getting money back. So the government lets you claim the $10,000 you paid, and if you itemize your deductions, and you get a refund when you file your state or city, then next year you have to claim that state and city refund as income on your next year's tax return. Okay, and the form you get to show you had a state and city refund is page 107. It's form 1099G, which happens to also be the unemployment form. But if you look right here, this is unemployment. Box 2 is state or local income tax refunds received. So the city sends one and the state sends one. All right. Not everybody gets these. Okay. So city tends to send them out to everybody, regardless if they itemized or not. And somehow it seems the state doesn't do that as much. So, but if they get one of these forms and they tend to not come in until like the end of January, even to February, you then have to look to see, well, did they itemize last year? All right. If they didn't itemize Schedule A, you don't put it on the tax return as income. If they itemized and claimed their state and city taxes paid as a deduction, well, then the refund probably will be considered as income on the current year return. Okay. So it's a little confusing. And actually, I was like, you know what? The easier way to do this to explain it is, and this I do this all the time. Google is amazing at how much it knows. So I typed in here and I just said, so if you ever find yourself thinking, I can't understand what Mark's saying, you can just Google it and probably find it in better, easier language. So when do I have to include my state refund as income on my tax return? You would have to report state income tax you received last year on your federal if you itemize deductions on your federal return last year. And it goes in, you can click on different little links. So I Google all the time. If I kind of have an idea how something might work on a tax return, but I need something to give me a little more guidance. So I just Google it, and I usually find an article that explains it. And obviously, I have to make sure it's correct because not all articles are correct on the internet. But I usually have a pretty good idea already how it works. But I encourage you guys to. Obviously, this asks us also, but if you ever find yourself like need an better explanation as you can't follow along with what I'm saying or when you're doing a return, just Google it. And if it contradicts what I said, then obviously you need to come to me or somebody and say, hey, who's right and who's wrong. But so anyway, that's kind of how that works. So that isn't the problem. One other thing I want to point out that I forgot on the Schedule A, back to 37. I think that's what Schedule A was. Okay, another part of the tax law changed in 2018. So taxes you paid, so we talked about real estate taxes, income taxes, car registration tags. So column or row 5 through 6 here, it's capped at $10,000. Okay, so if I add up what I paid in state and city taxes, my property taxes, my car registration, if it adds up to like 15,000, it automatically gets capped at 10. All right, so that was a big tax law change in 2018, and it got a lot of people upset, like in this New York City, Los Angeles areas that are high wage earners. Like you have to make a lot of money just to live there, even if you're not considered, wealthy or anything like that. But because what they took out of them in state and city taxes actually exceeded that 10,000 right off the bat. So then if they owned a home, they're basically not getting any credit for any property taxes they paid on their home because they're already exceeding the 10,000. So that does come into play with some of our clients that are making more money. And the software automatically does it. But I just wanted to kind of make you aware of that's kind of how that works right in here. It gets capped at 10,000. So, and of course, this you have to get above 7.5% on your medical. All right. So with that all being said, let's jump into our problem. Okay, problem 22. So I'm going to click on my client information sheet, and I'm going to key everything in for you because we're only doing one problem. And I'm just going to show it to you, and then I'm going to pull Drake over here and actually do it. But you guys can pull this up too or print it off, whatever. And if you have two screens, it definitely would make it easier for you. So it's Mark Grimes. He's a single. And I'm going to point out the things that are going to be important in the problem. So he did work in the city, okay, but he did not live in the city. So right away you should say that's a non-resident city return, okay. He has to pay a 0.5% tax for the taxes or the earnings he had while working in the city. Obviously he's not being claimed as dependent. We talked about that. Single, made it easy, has actually no dependents. So we actually do have clients like this. But he is a homeowner. So he's Lansing Schools, non-resident, and he has one W-2, has some interest income. And here's his medical bills, mortgage interest, real estate taxes, and charitable donations, just what we just talked about, okay, because we're going to do a Schedule A for him. And let's see, heat credit, we'll put in for the heat credit, but I think his income might be too high. He's not renting because he's a homeowner. And he's going to have, if he gets a refund, he wants direct deposit. If he owes, he wants direct debit. Okay, so I'm going to go ahead and move this over to my other screen and pull up my Drake. All right, I'm going to close this out now. And of course, I timed out with my Drake. Close this. Okay, so start with a social. 800. Oops. 800. Okay, so I know he's single, he has no dependents. Mark A, not going to put any punctuation in there, right? Birth date 04/16, shortcut, I don't have to put 19 in there, 72. Occupation is he is a sales manager. And his cell phone, 7214. All right. And I might shortcut a few of these things because I know you guys know how to do them. And all right, address 1440. Again, no punctuation. He's not in an apartment, he's in the house. So F4 to get rid of the flag. 48906. And he's a non-resident, I said, so I don't put LN in here. That's only if he's a resident. So I'm going to F4 that. And he's in the Lansing schools. I know that's 33020. Yes to this. Student preparer. Okay, now I'm going to go ahead and minimize this real quick and pull up his W-2 before I dig into all the other stuff. That's what his W-2 looks like. He is Sears. And what I want to point out here in his W-2 is you look over here, he made $55,242. He said he worked in the city, but look down here. They didn't take any city taxes out. So based on my W-2, it's telling me he did not work in the city or live in the city. And as I told you before, you cannot rely on the W-2 for city information. Okay, you pretty much have to ask the client every time, which the client information sheet does, did you work in the city? Because I do not believe the W-2. If I believe the W-2 in this example, he would not pay any city taxes, and he probably would end up getting a letter later on. And we don't want letters to go out to our clients. Okay, so he told me he lived in the city. I probably would ask him or point out, did you know they didn't take any city taxes out of you? And he might say, no, I have no idea. Why wouldn't they take city taxes? I'm like, I don't know, but you want to. And then I would tell them, I want to do his tax return. And again, this is hard for you guys because you're new. If you can give them some advice, that actually is reasons why they maybe want to come to us and not do it on their own on TurboTax. Okay, because we're going to point things out that they might not see if they're trying to do it themselves. So in this case, I'd say I would definitely go to Sears payroll department and tell them to start taking city taxes out because you're going to owe money when we file your taxes, and the city can assess you with a penalty if you owe more than $100 when you file your tax return. Okay, that's what I tell them. Now I've been doing this for 25 years. Okay, so I have more knowledge than you guys do, but that's our goal. Okay, but my big thing is don't trust the W-2 always for the city information because the payroll department is not always correct. I always kind of try to verify it with the client. Okay. Now the returns I do over and over again for the last 20 years, obviously it's same employer. I know what's going on, but for new people, I don't know. All right, so that's what's going on in this example. Let me key this in now. Go back to my Drake. T for taxpayer. Obviously that's really important. Don't screw that up. Sears, 55,242, 4850. And again, this example, they all happen to be the same. I can plow right through here. Click on retirement plan because it shows it's in there. Make sure I put MI for Michigan. Withholdings 2,300. Okay, so right here now I'm like, all right, well the W-2 shows no local wages. What do I do? But he told me all this should be taxed in Lansing is what he told me. So I come over here and I'm locality, I'm going to put LN. So as soon as I put LN, you should know that, and as I told you before, Drake looks at box 1. It could care less about box 18. So I don't have to put anything in any of these things. It's automatically going to create a non-resident return taxing the full $55,242 because that's exactly what I'm telling Drake to do. So I just put LN here. Now, if he would have said, I only worked half the year in Lansing. Well, then I'd start doing my LN 130 space 260, which means 130 days out of 260 is what I worked in Lansing. But in his case, he said I worked the whole year in Lansing, so that's why I'm leaving it just as LN. Okay, so I'm gonna escape out of here. That's all I need for my W-2. Close that out. All right, now let's start looking at, don't want to do that. Minimize this. Okay, now I'm gonna start looking at this. So I have interest income. I'm probably have to go back and forth with this. Interest income, MSU Federal Credit Union, $35. So where do I put that? I kind of showed you in the manual, but I'm gonna show you exactly. So right here, I'm gonna go to my INT screen, and I'm just gonna click on it. I could type INT if I wanted to. I pop in here, I got some flag fields. I need to tell you as a taxpayer or spouse, I'm gonna say taxpayer. And then, as you notice, if you remember what I said in the manual, I like to put what is needed, and I don't like to overdo it because it wastes time. So I just do MSU Credit Union, it automatically defaults. I'm not putting EIN number, I'm not putting address because it's not necessary. That's why I didn't flag it. Okay, now it's $35, I just put 35. This is probably all you're ever gonna do for your interest income tax returns, okay? Unless you guys end up doing them later in March, and then it has a few other items on it. But for the most part, this is pretty much it. Escape to get out. Okay, now let's look what we have next. I'm gonna minimize this. Okay, now I have Schedule A information. So I got doctor bills, that's medical, real estate taxes. Oh, I'm gonna look this up, and he's in DeWitt Charter Township. I'm gonna show you how that works. Car registration, that's personal property. Mortgage interest, cash check donations to the church, $1,500, and then clothing donations to Goodwill, $300. All right, so I'm gonna show you where all this stuff goes. Move it back over here so I can see it. I go to my Schedule A. If you notice, I didn't even flag medical up here because so many returns we do are not considered that medical doesn't come into play, so I don't even flag anything up here. In this case, he did say he had doctor bills, so those would be, they're not insurance premiums, they're not medical miles, doctor bills. So I come right here and I say 500. He then said real estate. I'm going to skip real estate taxes first for now because I'm going to show you where to look. Car registration tags, that's personal property. Usually that's every single return we do. They have car tags, 219. Mortgage interest right down here, 9,500. Now I guess I didn't put down he had mortgage insurance premiums. So probably 50% of the ones we do have mortgage insurance premiums. The other 50% don't have it. In this case, he didn't have it. I just F4, get rid of my flag. Donations, normally they have cash or check. I could probably flag this field too, because a lot of times they have other than cash. I might flag this one too later for you guys. So this one up here is 1,500, and this one right here, Goodwill, it's under 500. I don't have to do Form 8283, $300. So real estate taxes. All right, as I said, this is real estate taxes paid, not assessed. What actually was paid in this example, we're in 2019. So in 2019. So a lot of times they have that information. It comes in on the mortgage statement, Form 1098. A lot of times they do not. We have to go look it up. Same way when we looked up for the property tax credit. One more thing I want to point out. See here, it says Form 1098. If they come in with Form 1098 with the mortgage interest, which they normally do, don't waste your time filling this screen out. When I click on this, I can fill this all out and it flows right into the Schedule A. But why waste my time? It's not required, it's not needed, it's not necessary. Enter it right here, 9,500. You do that in 5 seconds. You fill this out, it takes you a minute. Which one would you rather do? If you know it's me, it's 5 seconds. What's the point? Don't fill that 1098. If I didn't teach you, don't do it. Okay. I see a lot of students, because one, they're learning, and I understand they're learning, and say they're fumbling around here like, I got a 1098 form. What did Mark say to do? Oh, here's a link. Click on this. If you don't even know what you're doing, that means I didn't teach you. I didn't teach you for a reason, because I don't want you to do it. Okay. You fill it out right there. I flagged pretty much every field that 90% of the returns you're probably going to see. So if you find yourself doing something and you're like, I don't remember Mark showing me that, then stop and come ask me or come ask somebody. And if you find somebody gave you an answer that you think Mark didn't give you the answer, stop and come ask me. And that means that senior preparer is doing it incorrectly, which unfortunately, I wish we weren't doing it, but I'm sure there's still some people that do things that I don't want them to do. And they either I don't know they're doing it or they've had bad habits over the years, but let's do things the way Mark wants to do them. Okay, so now let's go back here to real estate taxes. All right, so I'm going to minimize this. Actually, let me get the address here. So the address is, I know it's DeWitt Charter Township because they told me, and I'm at 1440 Boyshot Road, and it's 48906. So even though it's DeWitt Township, which a lot of you guys probably don't even know where that is, it has a Lansing mailing address, which is common. So now I'm going to pull this back over here. I'm going to go into my problem file, down to my favorite links, because that's where my property tax search area is. So this is what will pop up. So I have a list of my cities, and so far I think we've gone into Lansing. So here I have DeWitt Charter Township. I just click on that. And I'm going to enter the address, 144. I actually have it because I've done this. I hit enter. So you guys should be aware or familiar with this. So I'm just going to click on the link. And it's going to pull up, obviously, is where I got my, when we were doing property tax. I know you haven't done many of these, but we're going to do it today. So I'll make this bigger. I go to the tab that says tax information. Scroll down. And obviously, because now we're in 2020, I'm only focusing on 2019 because that's the return we're doing right now. So I'm going to come over here. So these are right here where it says 19. These are what's assessed. So I'm in the Lansing area, for the most part, it's usually winter and summer taxes. That's how it works. But they can, so that's how they're assessed. Always winter, summer, 2 in a year. All right. But you could pay more than one in a year. So you can overlap. So typically the winter taxes, I know you guys aren't homeowners, so you're not aware of this. Winter taxes, and they're usually due February of the following year. Sometimes people wait till February to pay it, and sometimes they pay 3, a winter, a summer, and then the next winter in the same year. So if you look here, this person actually paid 3 in 1 year. So I'm looking at the date paid, not assessed for Schedule A. Okay, when I do my property tax credit on the state of Michigan, it's what is assessed, not paid. Like if this person didn't pay anything, but they were assessed taxes, which they're always assessed, that goes on the Michigan property tax credit. This is where sometimes people, I know the clients get confused all the time. They're like, which one do you want? The one I paid or the one that was assessed? Michigan's assessed. Federal Schedule A is what is paid in the year paid. So in this one, I have 3 of them. So I'm going to go ahead and log these 3 in. So I got to kind of move this out of the way here because I got to pull up my Drake. Let me pull it back down here. All right, move it over here so I can see it. Okay, go back to my Schedule A. So what I'm going to do is I'm going to pull this up. I'm going to double click it. Remember, double click it gives me. So another thing is, I know so far I've taught you because it really is a shortcut, but I know you type a description, and this is nice. You type a description, say summer, winter, summer, like winter 2019, whatever, and you put the amount over here. Honestly, I don't care if you type a description. I mean, if it gets long and you need to type a description, you can, but I'm looking for an audit trail right here so I can back into it. So I actually, a lot of times, I don't even type a description. I just put the amount, the numbers in, because I can figure out if I missed something. So I'm actually going to just put the amount in over here. So so I have what was paid. So I have winter, so 1,059, 1,059. And then he also paid summer 19, of 1,628, and I'm rounding 1,628. And then he paid his winter 2018 taxes in January 8th of 2019. That was 942 rounded. Okay. So these are this. Now I have to go in and I have to, and I'm going to pull this back over here so you guys can see it. As you remember, like these are what he paid, but there might be something in here that's not actually a tax. The only way to know that is if I take a peek and get the details. So I look here for 19, open this thing up, I scroll down, and you remember anything that doesn't have a millage rate, like these are 0, 0, 0, these are not taxes. So I have to back out my Bighorn drain, that's minus 235, and my Prairie Creek minus 6, and I'm rounding, and my street lights minus 44. Okay, so that's for that one. All right. Now I'm going to scroll down here. I'm going to click on my 2019 summer that he paid in 19. Scroll down here. I don't see any 0 millage rates, so I'm good to go. And admin fees, they do let me put that in. They, even though it's really not a tax, they consider it a tax for tax purposes on your income tax return. So you can include this amount here. So now I'm going to go back here because I did include this 941.83 because he paid it in 19. So I'm going to open this up. And here I got some more 0 millage rates. So I'm backing this out again. So my Bighorn drain. So I got another minus 242 and a minus 43. Okay, so that's that. Now I'm going to come back over here. And I'm going to go ahead and, when you're doing this, make sure you put the negative in here. Otherwise, you're going to be adding to it, and make sure you put the right amount in there. Minus 235, minus 6, minus 44, minus 242, minus 43. So these are all the things I backed out that aren't considered taxes, all right? Now this stuff, this detail information, like the only thing that goes to the IRS is the total amount, not this. This is just for us, so we know how we arrived at this amount of money. So say he gets audited and they come back and they say, prove to us that you paid these 3,059, and he comes back to us and says, hey Mark, why did you put 3,059 on here? I can't figure out where you came up with that figure. Well, I open this up and I see my numbers right here. Now granted, it would probably be nice if I put descriptions on each one. Okay, but I know where I got this from, and I pull back up his property tax statements and I look and see, and these numbers would all match up. And so I could tell him this is Bighorn, this is Prairie Creek, these are your street lights. Okay, because I can tie back into the numbers. These numbers match up with the property tax statement. So that's why we do break out the detail. Okay, so that takes care of my property taxes paid, all right? Now, since I already have this page up, let's go to Michigan, all right? So now for the heat credit, I think he said his heat bill, obviously it's a house, so it's not included in rent because he's not paying rent. So it's not included, so I do an Alt-N to get me into my heat, all right? And then I know he's in Clinton County, so if I come down here, is there Clinton County? Yeah, Clinton County, 19. And then I think he had, I don't know if he had consumers, for this example, I'm gonna say he had consumers and he had gas. Okay. Now, because I've been doing taxes for a long time, I know he's not gonna get the heat credit because his income is too high and he's a single person. But for you guys, just fill the heat credit out on every single tax return, because one, it's one less thing you have to think about, like, oh, is he going to get it or is he not going to get it? So just do it. It takes, normally I don't like to cut corners. I mean, I like to cut corners like but with you guys, you already have a lot to remember. So if you just do a heat credit on every single, obviously they have to fill out in the client information sheet that they actually paid heat, all right? If they didn't do that, then you don't bother. But it only takes, as you saw, it took me 15 seconds at that. And then I don't have to worry about it where I don't, because occasionally, sometimes we miss them. And the way the heat credit works is, I mean, like I said, you can always go back and fix things when you make a mistake. But with the heat credit, that expires September 30th so if we file taxes, say in February, on September 30th, if you didn't apply for a heat credit, you're done. Okay, usually you got 3 years to fix mistakes. With heat credits, September 30th, it's done. So you screw up, you forget to give them a heat credit, and say they come back next year and then we do a return and somebody gets a $200 heat credit and like, wow, I don't remember that last year. I go back and look and like say, oh, Kyle forgot to put it on there. Guess what? I can't fix it. All right, because September 30th, it's done. All right, so the reason I'm saying that is it's just enter it. I'd rather you waste the 15 seconds on ones that I know you're not going to get it, but because it might help prevent you from making a mistake on ones that do get it and you just forget to do it. So, okay. All right, getting back to this now. So now I'm going to go to my, they're a homeowner. So we're going to do a Michigan property tax credit, right? So I pull this back over here and I'm just going to shrink these up here to make it easier to read. Okay, so now I'm doing Michigan homestead property tax credit. I don't care if he paid a dime to his property taxes. It's what's assessed, not what is paid. So I'm focusing on this column right here. I could care less if he paid these things. He still gets credit. And I'm looking at just 2019. Do not put this in here. Do not put this in here because he paid it in January of 19. He will get audited, okay, because you cannot put 3 in 1 year. It's what's assessed. So I have these numbers right here, okay, and then I'm going to back out, obviously, my Bighorn and my Prairie Creek. So I'm just going to move this over here so I can look at it. I'm going to pop this open. So I have my winter 19, 1,059. My summer 19 is 1,628. And I'm going to open this up to see what's assessed. And I have to back out. Make sure you put the minus in there, and it did not even take in minus. I'm backing out 235 because that's not a tax, minus my Prairie Creek and minus my street lights. And not everybody has this. You have to look and see. Some people, all it is taxes. They don't have any special assessments at all, but other people do. So the only way to know is to look. Okay, next I'm going to do I need the taxable value. So that's right there, 66,840. And that's for 2019. And you look, here's a school district right here, 33020. So I'm going to put this over here. So 66,840. Right here, 66,840. And you have to fill this out. Okay, so now I'm good with my property taxes. These are what was assessed for 2019. All right, now let's get back to what else is going on with, don't want to open that. Minimize, let me shrink this down. So going back into, I'm done with my property tax, so I can close this thing out. Now let's look here. I got my Schedule A. I took care of all this, got my interest income. Okay, here's state and Michigan refund in 2018. So he got a $650 refund from Michigan and a $10 refund, and he itemized last year. All right, so this is what we talked about at the end of the lecture. So now, because he received this, he itemized, so that means he claimed his state and city taxes last year, what he paid in, but then he turned around and got the money back, this money back. So now I have to include this as income. So how I do that is I move it over here, close this, pull up Drake, go into my income tab right here, screen 3. And right here, Schedule 1, additional income, taxable refund, state taxes, local taxes. So I got state taxes, and here I have the Form 99G. Remember I told you that? This pops open. Don't waste your time keying it in. Okay. Again, this is going to take you a minute to do. All you got to do is enter the amount, the refund amount. You don't have to key that in. So 650, and then this is 10, local taxes. Okay. That's it. Now, if we did his return last year, it would automatically carry forward what should be included, his taxable refund amount, what amount should be included here as income, okay? If the amounts here are different than the form he brings in, most likely Drake is actually correct. I don't want to get into it with this class. but there are some other calculations that go into play to determine of that refund, is it all taxable or not. Drake does the formula, the calculations, and it'll automatically do that. So rely on what Drake says as opposed to what the form says, because then not all of the refund would be taxable. And you can always ask a senior preparer or come ask me, and we can figure it out. Okay, close that out. That takes care of that. Michigan information. Mark lives in DeWitt Charter Township. Look up property taxes. We just did that, and we backed out the special assessments. Don't worry about the car insurance. We'll talk about that in a later class. City of Lansing, non-resident. He lived outside the city, but he worked in Lansing the entire year, and that's it. We're done. Now I'm going to do my Alt-P, and I changed the macro. Alt-P will now go in and also check off the EF does not want a bank product. For this one, I'm just going to go in to make it speed up. I'm going to say he didn't have an ID. So I have to key that in, but you guys would key that in. Now I'm going to go ahead and do my my Michigan Alt-U for my use tax. Okay, he didn't have any use tax. I'll do my Alt-E, even though I really don't need to, but again, I'd rather have you guys just get in the habit of doing it all the time. That's my due diligence for the earned income credit, which I know he's not going to get because his single person made $55,000. He's not eligible for earned income credit. There's really no due diligence questions to ask on this tax return for this individual. So I view the return. I get all my green checks, which is nice. He's getting a refund of $355 from federal, $328 from Michigan, and he owes $273 to Lansing, and that's because he has to pay a 0.5% tax because he's a non-resident, and they took 0 out of him. Let's go ahead and take a look. So I got my 1040. Here's my Schedule A. So let's look at the 1040 here. So I've got a single taxpayer, no dependents. So here's my W-2. Here's my interest income, $35. It's taxable. Other income, $660. And what that is my taxable refunds, state and city, right here. Flows over to the 1040. Gets added into my income. Here's my, if you look here, line 9, standard deduction or itemized deductions from Schedule A. Again, all the problems we've done up until now have always been standard deduction, and you probably didn't even read this other part because it never came into play. So now, if you look here, he's single. This should be, I keep saying it's 12,200. Let me just double check. Yeah, 12,200. I think 12,400 for 2020 is the standard deduction. So you look, his itemized are actually higher, 16,878. So Drake knows that, so it takes the higher of the two. So it'll subtract it from his income to, lower his tax. So let's take a look at the Schedule A now. It's right here. So let's take a look at medical first. So if you look, we said $500 he had medical bills. And remember I told you it has to get above 7.5% of his adjusted gross income. So his adjusted gross income, $55,937. And that's coming from right here actually, adjusted gross income multiplied by 7.5% equals $4,195. He's got to get above this amount before he can deduct a penny. He's at 500, 0, nothing deductible. And this is common, okay? But if they give you medical bills or medical insurance or whatever, put it in here so that they can actually see that that you put it in. Whereas if you just blow it off and don't put it in, then they're thinking you are blowing it off and you're not putting it in and you're not giving them credit for it. So, plug it in, let the software do its job, and it'll show 0. And so they can see it too. Taxes paid. This is coming from his state and local income taxes or general sales tax, $2,300. So if I go to his W-2, $2,300, box 17, that's his state taxes. He didn't pay any local city taxes. Remember, they didn't take anything out. This automatically flows right to the Schedule A. There it is right there. Real estate, state and local real estate taxes, those are all the ones we plugged in. $3,059. Remember, we did 3 years, winter, summer, winter. And then we backed out his the Bighorn, special assessment, streetlights, and all that. That's the net amount right here. Here's his car registration tags. Add them all together, $5,578. Here's the cap I told you. $10,000 is the cap. If he did married filing separate, it'd cap it at $5,000. He's well below that. So he's allowed all these as a deduction. These are all his taxes he paid in 2019. Mortgage interest, $9,500. He didn't have any mortgage insurance premiums, so there's his total $9,500. Gifts, cash or check. Remember, he had $1,500 to church and $300 to Goodwill. Add together $1,800. So we had $1,800, $9,500, $5,578. Add them all up equals $16,878. Go back to my 1040. $16,878. Bring it down here, subtract it. Here's my taxable income. I go to the back side. He's a single. His tax is $4,495. They took out $4,850 from his paycheck. Shows up on his W-2. He's actually getting a small refund of $355. Let's go to Michigan. That one, again, this just pulls over his adjusted gross income, $55,937. It's going to back out this $660, which is coming from Schedule 1 here. Because this is his state and local taxes, he doesn't have to pay tax on that in the state of Michigan. Okay, so, or city of Lansing, so it just backs it out. So now here's income subject to tax is $55,270. There's his exemption, $4,400, because he's a single, no dependents. Tax is taxable income $50,877. His tax 0.0425 is $2,162. He gets a property tax credit of $190, which is right here on the MICR. Here's his taxable value. Those are his property taxes after the special assessment's backed out. And it does a calculation on that form. And then, of course, it rolls it into his Michigan 1040. Withholding on the W-2, $2,300. So he gets a refund of $328. Go to Lansing. Here he has his wages of $55,242. We said he earned those all in Lansing, even though his employer didn't take any city taxes out. His interest is not taxable because he is not a resident of Lansing, so only when he worked in Lansing. This is his local refunds. That's not taxable. So he gets his exemption of $600. 0.5% is $273 in tax, and that is what he owes, $273. You will then tell him, just so you know, if you owe more than $100 and you file your city return, the city can assess you with a penalty. Okay, you need to talk to your payroll department and tell them to start taking taxes out of you so you don't owe this $273. Okay, and he will say thank you for letting me know that. So now he wants to do direct debit and he wants to do direct deposit of his refunds. So to do that, I'm going to pull my sheet back up if I have it, not this one. So here's my client information sheet, and that's my old one. Do I not have it? Did I close it out? Here it is. Okay, so right down here, this is where he said he wanted to do direct debit and direct deposit. Here's the account information. I'm going to move this back over here. So direct deposit, I'm going to say yes for federal, Michigan, and it's Chase Bank, 072-000-326, and his account number is, I'm just going to make it easy and do 123. Checking, I have to repeat it, 072-326-123. Checking, okay, that takes care of my direct deposit. Now I come down here for payment, and federal, no, because he's getting a refund. LN for Lansing. Chase, 072. I know it's annoying because you got to do it over again, but you do. Checking, 072, 123. Checking. See how it has a requested payment date? Well, that's federal. So I'm going to F4 that because his federal is not going in here. It's going to be state right down here. So I'm going to go ahead and F4 that one, or actually I'll let it default to what no, it says state, but the state, if you look up here, it's state/city. So because the state and the city are all thrown in the same drop down, so it says state down here, but it's really state/city, but Drake did not put state/city. So I'm going to go ahead and view this, and I know we're beyond the actual e-filing deadline date, so I'm not sure if it's going to, if it's going to, still got my green checks, that's good. So now when I hit my continue, I'm going to go to my sets tab right here, and if you look at the result letter, which what the client normally does, because this summarizes the return, so he's getting refunds and it shows direct deposit and it ends in that account. But what we like to print out for the client, this transaction summary, and we normally have them initial so they can verify that we didn't screw up and put the wrong account number in. I usually circle this, draw a line, and the initial here. But this is a good, it kind of itemizes it. It lists this out really nice where it says this is 355 federal going in, Michigan deposit, and then this is going to come out, and it actually says the date. So it's defaulting to today's date, and it's because April 15th has gone by, and I can't remember, the city might default to the current, I think the city still defaults to the due date of the tax return. So, but in this case, because the due date has already gone by, it's defaulting to today's date. And then the net amount would be right here. So this is a very nice for the client. They can see how this works. So it's not like they can have their federal refund go directly to the city of Lansing to pay it, which a lot of times they ask us that, but this is kind of almost the same thing. So it's going to come out of your same bank account. But the problem is, obviously if this is December 2nd, the 273 is going to come out before the refund goes in. So they got to make sure that they have at least 273 in their bank account. So there's no guarantee on when the refunds will ever go in to their bank account. We can give them a pretty good idea. It's usually within 21 days, but it is not a guarantee. So this, though, coming out, when we actually put a date, it's going to be pretty close to that date, give or take a day. So they have to make sure they have money in that account on this date. So that's how that works. One more thing I want to point out. So say if this was say they owed the federal government, the IRS, you would say yes here. Okay, they don't. And then one more thing you have to do on the PIN screen is come down here and you have to say, I give consent to allow the IRS to take the money out of my account to pay my taxes. I don't have to do that for state or city, but I do have to do it for federal. And that is all for our training session today. All right. Have a good one, guys.